If you approach your taxes the same way you always have, this year could catch you completely off guard. The IRS has officially opened the filing season for 2026, and while everything may look familiar on the surface, same forms, same deadlines, same process. Underneath, critical changes have quietly shifted how refunds are calculated, how returns are reviewed, and how long the entire process takes. Filing too early or filing without fully understanding these changes could delay your refund by weeks, even months, and in some cases, it could trigger issues you weren't expecting at all. There are new deductions this year that can genuinely help you keep more of your money, but there are also new friction points in the system that can work against you if you are not prepared. It is at that intersection of opportunity and risk where millions of people get tripped up every year. If your refund helps cover rent, bills, debt, or simply provides some breathing room, this matters more than you might think. This is not information you want to discover after filing. It is something you need to know beforehand. Consider this. When you usually file your taxes, do you rush to submit as soon as your W-2 arrives, almost like a reflex? Or do you wait a bit, perhaps until March or closer to the April deadline, once you are sure all your documents have arrived? There is no right or wrong answer, but this year that decision matters more than it has in a long time. Filing early, which worked fine in previous years, may not guarantee a faster refund now. In fact, filing too early without everything perfectly aligned could put you into a slower lane. Most of the risks are not obvious while filling out the return. They appear later when a refund is still processing, when a letter arrives asking for clarification, or when weeks pass with no update at all. Timing is about more than being early or late. It is about being ready. January 26 is the first day the IRS will officially accept and begin processing tax returns for the 2025 tax year. That marks the start of the 2026 filing season. At first glance, that seems completely normal. Late January has been the standard for years. But many people make a subtle mistake. They see that date and assume filing on or immediately after January 26 automatically gives them an advantage. In previous years, filing early often felt like the smart move. Get it done, get your refund moving, check it off your list. This year, that assumption does not hold the same weight. Filing early only works in your favor if everything in your return is perfectly aligned with the new rules, the new systems, and the new verification process. Otherwise, early filing can actually slow things down. What makes 2026 different is not something visible when you open your tax software or download forms. It is happening behind the scenes. Over the past year, major tax law changes were passed and are now fully in effect for the return you are about to file. At the same time, the IRS is entering the season with significantly fewer employees than last year. Entire departments that handle return reviews, correspondence, and problem resolution are operating with smaller teams. On top of that, the IRS is actively shifting how refunds are delivered, moving away from paper checks toward electronic payments as the default. Each of these changes individually would be manageable, but together they make this season more complex, more sensitive to errors, and more punishing if something goes wrong. For many households, tax season is more than just a routine administrative task. It is a major financial moment. That refund is often the largest lump sum received all year. It helps cover rent or a mortgage payment, catch up on utility bills, pay down credit cards, fix a car, or finally build a small emergency cushion. With prices still elevated across the board, groceries, housing, insurance, and healthcare, there is a lot riding on that refund arriving on time and in full. A delay of a few weeks can throw off a carefully balanced budget, while a delay of a few months can create real financial stress. Understanding these differences before filing gives you leverage. It allows you to avoid unnecessary delays, prevent mistakes, and approach the season with more confidence than the average filer. Rushing simply because the filing window has opened. One of the biggest reasons this season feels different is tied to a new tax law that quietly reshaped familiar rules. Last summer, a sweeping piece of legislation was signed into law, and every major provision applies directly to the 2025 tax return. On the surface, some changes sound straightforward, even helpful, but once you sit down to file, that simplicity fades quickly. The law changed deductions, credits, income thresholds, and how certain types of earnings are treated. While the intention was to provide relief to working households, the reality is that these changes added new layers of complexity that many people are not yet prepared for. Among the most talked about changes are new deductions. Workers who earn tips can now deduct a portion of that income. People who regularly work overtime may deduct part of that extra pay. For the first time, certain car loan interest payments may qualify for a deduction, similar in concept to mortgage interest. On paper, this sounds like excellent news. More deductions usually mean lower taxable income, translating to a smaller tax bill or a larger refund. For workers in service industries, hourly employees taking extra shifts, and families financing vehicles, these deductions could be meaningful. Potential deductions could reach up to $25,000 for tip income, up to $12,500 for overtime pay, and up to $10,000 for qualifying auto loan interest. However, employers did not update payroll withholding systems after this law passed. Tax withholding throughout 2025 often did not reflect these deductions, meaning many people had more tax withheld than necessary. While this could increase refunds, it also raises the chances of discrepancies between W-2s, your return, and IRS expectations. Any misalignment, even if you are entitled to the deduction, can trigger a manual review. This year, manual reviews can be lengthy because the IRS is operating with roughly 25% fewer employees than last year. Tasks that previously took a few weeks could now stretch into months. Accuracy matters more than ever. Beyond new deductions, other changes affect nearly everyone. The standard deduction has increased. Single filers now have a standard deduction of $15,850, while married couples filing jointly can claim $31,500. This increase is significant because the majority of taxpayers, roughly 85 to 90%, take the standard deduction rather than itemizing. A higher standard deduction lowers taxable income and can increase refunds. However, when combined with other new deductions and credits, it introduces additional complexity and room for miscalculations. The child tax credit has also increased, rising to $2,200 per qualifying child. For families with multiple children, this adds up quickly. 2 children mean an extra $400 compared to last year. 3 children yield $600 more. These increases can help offset daily expenses like groceries, clothing, and school supplies. But eligibility must be confirmed and reported accurately. Errors related to dependents or credits are a common reason for delayed returns, particularly with a lean IRS workforce. Another important change is the expansion of the state and local tax deduction, often called the SALT deduction. Previously capped at $10,000, the cap has now been raised to $40,000, benefiting households in high-tax states such as California, New York, New Jersey, Connecticut, and Illinois. Families earning between $200,000 and $500,000 could save roughly $1,200 or more, depending on their circumstances. This benefit only applies if you itemize deductions, so standard deduction filers are unaffected. Understanding these nuances is crucial to avoid claiming benefits you do not qualify for. In addition to legislative changes, the method of receiving refunds has evolved. The IRS is moving away from paper checks and encouraging electronic payments, while nearly 10 million people still receive paper checks. The push toward direct deposit is becoming the standard. Filing without bank account information may trigger follow-up letters and further delays. Direct deposits are generally received within about 21 days for straightforward, error-free returns, whereas paper checks can take 6 weeks or longer with risks of loss, theft, or mail delays. Switching to electronic delivery simplifies and accelerates the process. Timing remains critical. Filing immediately when the window opens may feel productive, but waiting can actually be advantageous. Some tax credits and deductions require additional documentation, which may not arrive until later. Filing prematurely often leads to amended returns, which take longer to process and increase the risk of delays. Accuracy and completeness outweigh speed this year. Another important consideration is withholding and refunds. A large refund may feel gratifying, but it often indicates over-withholding throughout the year. Ideally, your withholding should closely match your tax liability, keeping your money in your pocket rather than loaning it interest-free to the government. Reviewing and adjusting your W-4 with your employer may be worth considering if large refunds are routine. For those with more complex tax situations, multiple income sources, investment income, side businesses, or new deductions, using reputable tax software or consulting a qualified professional can save time, prevent errors, and reduce stress. These resources are investments in accuracy and peace of mind, not a reflection of intelligence or capability. Before filing, conduct a thorough review of all information: Social Security numbers, bank account details, income sources, and documentation for all deductions and credits. This quality check takes minimal time but can prevent major delays. After filing, monitor your return through online IRS tools to catch issues early. Special circumstances require attention. Income earned through gig work or platforms like rideshare or delivery services must be reported, and business expenses can be deducted appropriately. Unemployment benefits, cryptocurrency transactions, economic impact payments, and changes in filing status or dependents must be correctly reported to avoid delays. The 2026 filing season will likely test the IRS as much as taxpayers. Fewer staff, new rules, and increased automation may create bottlenecks, but thorough preparation on your part minimizes frustration. Gathering all documents, understanding applicable rules, double-checking details, and filing only when confident in your return's accuracy increases the likelihood of a smooth process, timely refunds, and avoidance of lengthy delays. Tax season can feel overwhelming, but with organization, patience, and careful attention, it is manageable. Millions successfully navigate complex filings each year, and you can too. By approaching this season with precision over speed and preparation over habit, you protect yourself from unnecessary stress and maximize your chance of receiving the refund you are entitled to.